All right. Good morning, everybody. Coming to you from snowy Connecticut. Pretty cool. So, as you might see, I have the CNBC website up here. The CNBC website's okay, but the channel is just so unwatchable, man. It's like, why don't they bring in some new people? Kramer, Joe Kiernan. These guys have been there for 30 years, right? And I actually had a friend who worked for Kramer. I've actually had two friends that work for Kramer, and they say that they say he's a very nice guy, but it's very different than his TV persona. They say he's actually kind of quiet and chill. But anyway, that being said, all right, let's just take a quick look here. The stock markets are very quiet this morning. We'll start off here with the S&P 500. See what's going on over there. Yeah, I mean, basically we're unchanged now, 1 basis point. So not too much going on there. Let's take a look at Bitcoin because we looks like we're going to cross the $100,000 mark. Ooh, look at that. We're really close. Now there's probably going to be some resistance around 100,000 because like everyone and their Aunt Mary is like, oh, if it gets to 100,000, I'm going to sell. People like to sell at nice round levels. It's just one of those things, but it's very overbought. So overbought means it's trading above its like usual or typical trading range, or what would be its usual, typical, or trading range. So a lot of Wall Street strategies are based on this concept of reversion to the mean. So there's a good chance there's going to be some kind of a reversion here. I mean, I don't know where it's going to be in 5 years, but I wouldn't be surprised to see some profit taken and see it head lower today or next week. Next thing I want to look at is oil. Now, remember, if you don't trade oil, if you don't trade futures, that's okay because there are ETFs that you can get exposure to oil. USO is one of them. Now, look at this, right? This should really boggle your mind. And this is why, I mean, most technical analysts suck, but hey, you're talking to the guy over here who doesn't. I've been doing this a long time. And, people think technical analysis is like, you find these patterns, and it's like astrology. And then you get this garbage like GAN theory and Elliott wave. It's like, look, man, this is what I tell my students: levels, trends, momentum. That's what technical analysis is. Now, the reason why this should boggle your mind is because think of how big the oil market is. It's almost unfathomable. It's like all over the world, it's worth trillions of dollars. And yet, for the last 2 years, or a year and a half, I should say, every time oil has gone down to 67.30, what has happened? It's rallied. Now, why would a level that was support here become support here and 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 here? Well, people sell here at the bottom and then the price takes off. And a lot of the people that sold are like, this sucks. If I could buy my oil back at the same price I sold it at, I'm going to. So they wait. And when it finally gets back to the level they sold at, they buy it back. So remorseful sellers placing buy orders can keep the level that was support intact. All right. See that right across here. And another thing about technical analysis that we're looking at, just don't think about like we're looking at oil. Thinking about it like we're looking at the psychology of the people that trade oil. You can see the same patterns in various different charts. And there's a reason for that. It's because regardless of what you're trading, people have the same emotions. So whether you're trading oil or Bitcoin or gold or stocks or ETFs, you see the same patterns because people have the same emotions. All right. Next question: why does something rally when it gets to support? Well, this is also psychology. We find support at former support levels because of seller's remorse. Whoops. Oh, God, get off of here. And we rally off of support because some of the people that want to buy start to get concerned. They start to sense that there's other buyers coming into the market, and they're afraid that the sellers will go to whoever they know the sellers are going to go to whoever is willing to pay the highest price. So they're afraid other people might be willing to pay a higher price. So they increase the price they're gonna be willing to pay. Other people see that and they do the same thing, and you get this snowball effect. It's like a bidding war. This is kind of interesting here. This is your old, what we would call your bullish engulfing pattern. Now, think about this. Candlestick charting was invented by Japanese rice farmers or rice traders, I should say, back in the 1500s. And we're looking at the same patterns here that they did back then. And why is that? Well, a lot of things have changed in the last 700 years, right? But what hasn't is human psychology. But this is the old bullish engulfing pattern. See, what happens is you're in this downtrend, and on this morning here on Monday, it looked like it was going to be another down day. The opening was lower than the prior day's close. But so in the morning, you would have said, oh, it's going to be another down day. But by the close, what happened? The buyers pushed it all the way back. And importantly, it closed above the prior day's open. So it engulfed the trading. Sometimes it engulfed the trading of the prior day. Sometimes trends change over an extended period of time. In a situation like that, you might see something that looks like a rounded top or a rounded bottom. But sometimes they change in one day. And that's what a bullish engulfing pattern can show. All righty, let's see what else we got here. Let's just take a quick look at gold. Oh, interesting. Gold is back. See, now look at that, right? Support at the same level that was support before. Now, if you want to trade gold and you don't trade futures, you can trade the GLD ETF. GLD. Alrighty. All right. I don't know. Whatever. Let's look at NVIDIA. Kind of sick of hearing about NVIDIA. I'm kind of sick of hearing about AI, frankly. I mean, I read a lot of articles and so forth. There's not a day that goes by where I don't see like some misspelling or a picture that has nothing to do with whatever the articles, is about. And it's because people are just lazy. They're like, "Oh, let's let AI figure it out." Blah blah blah. All right. Anyway, so let's go through the big guys here. Apple. So that's Nvidia. Apple. Just going sideways. Now this is kind of the opposite here, right? Instead of getting support at a former support level, you get resistance at a former resistance level. People buy here, and then the thing falls out of bed, and they're like, "This sucks. I made a mistake. If I can ever get out at break even, I'm going to." So when it finally gets back to that level, that was the peak. Remorseful buyers from here, placing sell orders here, have created resistance at the level that was resistance before. There's an old saying on Wall Street: "Sell at former peaks," and this is why, right? It's because there tends to be resistance at former peaks because of buyer's remorse. And then it's the mirror image of what we were just talking about in oil. Some of the sellers start to get worried that they're going to get undercut. They know the buyers are going to go to whoever is willing to sell at the lowest price. So they reduce the price they're willing to sell at. Others see that. They do the same, and it becomes a snowball effect. So you get to support, you tend to rally. You get to resistance, you tend to sell off. Google. I hate Google, man. It's such a monopoly. It's got to be the biggest monopoly in the history of mankind. I mean, like I do work for Benzinga, and I think like 97% of the traffic that comes into Benzinga is uh is from Google. I mean, and they're all powerful. If like some congressperson ever like went after them, it'd be like, oh, guess what? We're gonna look at your email. I mean, they can just make or break people. All right. Facebook. Not really too much going on here. Tesla. Now, let me tell you something before I get going here that is quite important. You see that resistance at a former resistance level? Different sectors are in the driver's seat at different times. There's 11 different sectors. The strength in the market, whatever strength there has been coming from the consumer discretionary sector. All right. You see that big move there? Okay. And look at this resistance at a former resistance level. This is what we call market memory. Sometimes a price level that's important can stay important for a long time. So the consumer discretionary sector peaked here back in November of 21 at the same level that it just peaked at now. So we're talking 3 years later, right? This is what we call market memory. Now, this stock or this sector is dominated by Amazon. Amazon is 20% of it. And Amazon is trading at an important support level. See, this is a situation where what was resistance can become support. This is seller's remorse manifested in a different way. People sell here and they thought they had a great idea, but then the price eventually goes higher and they say, I made a mistake. If I can buy my shares back at the same price I sold them at, I'm going to. So when it reverses down to the level that was a peak, you tend to get support. Now, if this support breaks, the biggest stock in the sector that's been driving the market will head lower, and that should be bearish for the entire stock market. So just keep an eye on Amazon. Just remember, some levels are more important than others. Support can stay intact, resistance can stay intact, support can become resistance, and resistance can become support, and it's all because of psychology. Okay, everybody, thanks you so much. Hope you have a nice weekend, and I will see you all soon.